Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a clothing store or a shoe store. So we are modeling a chain of 40 stores, and today we will be dealing with a very interesting instrument. We will be building sensitivity analysis. So sensitivity analysis helps you to test your business idea, so you can add a parameter to any of the inputs or group of inputs and increase or decrease these parameter and see how this will affect the financials. For example, net present value, internal rate of return, simple discounted payback period, total financing needed for the business, total cash, for example, generated by the business idea, but this particular scenario. So if we are looking at any scenario that we've built, so it is a static story, like for example this one, what we are looking at the moment. But we need to know if this scenario is stable or not. So if we increase or decrease some parameter, will it be as stable as it is? Will it be as profitable as it is at the moment? Maybe if we just start increasing or decreasing some parameter, and this scenario will go to losses, and we need to know that. And sensitivity analysis helps us quickly create a range of scenarios, adding parameter to some inputs and see whether this scenario is good or not, it is stable or not. And today we will be building that. So guys, like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials, and when I completely finish this model I will give you all the links in the description of this video as well, so you will be able to watch the whole process from scratch till the final overview absolutely free. So first of all, let's very quickly run through what we did before during our previous tutorials. So we have 6 types of stores in our chain. Types of stores, not stores, but types of stores. So for example, small store, medium store, big store, huge store, stores that demonstrates, for example, losses. So we can create the portraits for these stores. And here we're setting up, so for example, let's dive into one of them. So we have 2 collections inside the store, spring, summer, and autumn, winter. Here we specify when we start selling this collection. This is the product range. So the rule is that all our inputs are colored with specific color, like this, like this, like this. So these are not the inputs, so we're not touching them during scenario modeling. And so here we have the product line, pricing. We can switch on and off different products from calculations. We have global and local coefficients for pricing, for scenario play. We specify the sales plan for the season for this collection. We have global and local coefficients for the sales plan. We specify the level of manufacturing costs out of prices. We have global and local coefficients for manufacturing costs. Then we are moving to the table of inputs, where we will be able to set up price discounting during the timeline while collection is inside the store, while we are selling this collection. Then we are allocating the percent of the sales plan sold during
the period. So the collection appears in the store in March, and in March, for example, we're selling 40% of products, of units of this product, of the total sales plan. Then on April we are selling 20%,
of sales plan, 10% of sales plan. So here we're allocating 100% of sales plan for this item. So we can do it specifically for each item in our collection. And then we are moving to autumn winter collection and doing the same, specifying month, pricing, sales plan, manufacturing costs. Then we are moving to manufacturing cost allocation. So these are collections. This is the moment when collections start selling in store, and before this, 6 months prior, we are allocating 100% of manufacturing costs before the collection gets inside the store. So this is for spring-summer collection allocation of manufacturing costs, and this is for autumn-winter collection allocation of manufacturing costs before collection appears in the store. Then we are describing fixed costs for this type of store. This is the names of fixed cost items. Monthly values, we can switch them on and off from calculations. We have global and local coefficients for fixed costs. Then we are specifying the payroll, positions, amount of people on each position, then the salary per person on each position. We can switch on and off different positions from calculations. We can play with global and local coefficients. Then we are talking about investment plans. So here we are describing what we are investing in. This is the moment when operating activity starts, and before this we have 6-month period prior to this moment where we're allocating the investment plan. So here we're specifying how much we are investing in these or that items. So we can switch on and off different investment plan costs. We have global and local coefficients for investment plan. Then we are specifying the life cycle. We're specifying the life cycle for the store. For example, if we create a portrait of a store which will generate losses, we will just set up here, for example, 36 months, and then the store will disappear after 36 months of operating activity. Then we are setting up the asset tax, monthly asset tax value. Then we are moving to the block of inputs where we set up the speed with which we are reaching the target revenue. So this is very important block of inputs, because when we open a new store, we won't be able to get the 100% of revenues right from the first month. And this means that in 99% of cases we will face operating losses, and these losses will be added to investment stage costs, and these costs, investment stage costs plus operating losses, will finally form the total amount of financing needed for this business idea. So this is very important block of inputs. Then so we have 6 portraits. I just show you one of them. Then we are setting up the first year of our financial projections. Here we have global coefficients for pricing, sales plan, manufacturing costs, fixed costs, payroll, and investment plan. So we can, for example, increase the investment plan costs 4 times, for example. See how the diagram will change, for example. So we can very quickly play with these coefficients. We can then we have a table where we can name our 6 portraits of stores. We can switch them on and off from calculations from the cash flow. And then we have a very important block of inputs. So here we have the chain. Here we have the chain of 40 stores. and for each store we can specify the type, what type of store is it. When we're going to open this store, we can switch on and off this store specifically to see how this store affects the project, the chain itself. Then we are moving to adding a loan. So here we can specify the
amount of loan, term of loan, interest rate, grace period for interest payments, grace period for principal payments, when we get this loan, year and month. Then we are adding management company. So we have three variants of adding a management company. The first variant, for example, we are adding a management company when we open the first store. First variant. The second variant, so we can set up the amount of stores in chain when the chain reaches this or that amount of stores, we will be opening a management company. So here we specify, for example, when the chain reaches 15 stores, we're opening a management company. And the third variant is manual. So when we are manually setting up the year and month, when we are adding a management company to our project. Then we are setting up one of these three variants for calculations. We can switch on and off a management company from calculations to see the performance, to see the clear breadth of our business idea with or without a management company. Then we are adding fixed costs of management company, payroll of management company, investment plan, management company. Then we are adding management company asset tax. Then we're setting up the tax rates. Then we start building cash flow statement. We are calculating financing. Then we are calculating simple and discounted payback period. Then we were moving to internal rate of return. We calculated the internal rate of return. And now it's time to move to sensitivity analysis. So first of all, let's choose the parameters that we will be testing. So for scenario analysis, for sensitivity analysis, we need to first of all we need to select what parameters we will be testing. So here I will create a very simple table. So this will be let's say financial efficiency. So this will be parameter, this will be value, so the first parameter will be simple payback period in months, simple payback period in months. Then the next parameter will be, for example, discounted payback period, in months. Then we will add net income, this will be in dollars. Then we will add net present value,
net present value, NPV. Then I will add internal rate of return, this will be in percentages. Then I will add total financing needed, and I will add cash generated by business at the end of the period. And we can add, for example, net present value. Let's add here, for example, profitability index. This will be profitability index, PI. So profitability index. So these are the parameters that we will be testing, and here we will be pulling the data. So simple payback period, let's go to the bottom. So simple payback period, we are taking this value, simple payback period, then discounted payback period, discounted payback period, I will be taking this value, then net income, I will be taking from here the last value of this table. I can take it from here, okay. Then net present value, I will be pulling from here. Then profitability index will be 1 plus NPV divided by total financing needed. Okay, let's do the following. Total financing needed. Okay, this one. So internal rate of return, I'm pulling from here. Then total financing needed. I'm going here, and after cash flow statement we have this wonderful table. Cash generated by business, we are putting equals and going to the cash flow statement. So this is the cash flow statement. I'm going to cash balance at the end of the period. I'm going to the end of the project, and I'm taking the last value in cash balance at the end of the period line. So these are the parameters that I will be testing in my sensitivity analysis. So what I will do now, I need to write a macro for that. So let's save this file as. Then here I will be choosing Excel macro enabled template, save. Now let's go and create a new tab. Let's call it Sense. So what we can do now, let's go and copy this table. Go here, paste it. Now let's copy formats. So what I need to do now, now I need to add a parameter that I will be adding to the inputs. So the base value of this parameter is 100%. Then I need to add a step of changing the speed of step of changing the parameter. So I will be changing the input, let's say with the step of 10%. So this is the input, so I'm coloring it with blue, like I colored all our inputs with blue. Now I will create a table for sensitivity analysis. So let's say this will be the base value. So if this value minus this step minus this step will be less than 0, we will put 0, otherwise we will be calculating this expression. So here we will be increasing and decreasing the parameter that we would like to look at the input, and we will be able to see what will be the financial efficiency if the input that we are looking at will be 70% of base value, 80%, 110%, and so on. So if we, for example, take the step of 40%, we will see how values are changing here. So we can play with this step. So then let's copy these values here. Now let's record the macro. So we can go to View, Macro, Record Macro. So we will name it Sense. The shortcut will be Ctrl+Q. Description will be sensitivity analysis. Okay. So now we can see that we are recording a macro. So what we're doing, so we are placing here 70%. Then we are copying these values, then paste special as numbers, then 80% copy, then 90%, then 100%, then 110%, then 120, and finally 130. Now let's put the base value for this parameter, and now we can stop recording. So for example, we can delete these values from here, go to macro, view macro. Now we can see sense macro here. We can press run. We can see how our macro executed. So here we have the same values because our parameter is not linked to the model, so it is lives separate at the moment. But for example, what we can do, we can go to our model. For example, we can go to manufacturing costs, for example, and we can press equals and add this parameter to the model and press enter. Now sensitivity analysis is linked to the model. Now we can go to macro, view macro, press sense button and see we will be able to see how financial efficiency will change if we play with manufacturing costs. Let's do that. We can, for example, increase the percentages of changing these values. Let's go to internal rate of return, increase the step. What we can do else, we can go to developer, we can insert a button, assign a macro to this button, name it sensitivity analysis. Now we can press it. So what we can do, we can, for example, now detach this macro from, for example, from manufacturing costs, and add these costs and then this parameter to, for example, sales plan, and see how our scenario, this particular scenario, is stable if we increase or decrease the sales plan. And now we can play with any parameter of input. So we can, for example, go to specific store. We can, for example, go to its payroll, add this coefficient here, 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 everywhere. We can add this coefficient, for example, to the pricing, of to the pricing of this particular, for example, spring summer collection. So we can, for example, let's do that. Okay, so let's detach sensitivity analysis from this parameter. For example, we would like to see, we can go to the store number 1. Here we can see the pricing specifically for this type of store. So this is the price final, and we can add this well, we can do it easy, a little bit more easy. We can add this coefficient to its spring summer collection prices. So now we are adding this coefficient, the parameter, only to store type number 1 and spring summer collection prices only. So we can be adding this parameter to very specific input. So now we are pressing sense button. Now let's detach it. So of course we can create diagrams of that. We can, for example, decrease the step. We can add this coefficient, for example, to manufacturing costs, for example. Let's press sense button again. Or we can, for example, increase the step. So I just want to show you that we can add this parameter to any input. So now our model is very flexible, and this allows you to test different scenarios, their stability. So this will tell you a lot about your about this or that scenario that you've built without playing with inputs themselves. So this will allow you to create very quickly a huge amount of scenarios, test these scenarios, see how this or that parameter affects the financial efficiency of your business idea, looking at these financial efficiency numbers. So I hope you enjoyed this video. So see you guys in next videos. Like, share, subscribe. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials, and when I completely finish this model I will provide you with all the links in the description of this video as well, so you will be able to watch all tutorials absolutely free from the very beginning, from scratch till the final overview of this model. So thank you guys for watching, see you next videos, thank you and bye.